Gold is not acting right. While the headlines scream about attacks in the Hormuz Strait, the so-called geopolitical heartbeat should be pumping a lot harder. Instead, we are coiling. I am Eric from Alpha Market Meridian. Please subscribe my channel before we continue. We have a trap being built right in front of us, a liquidity vacuum that will break violently, and most retail traders are looking the wrong way. There is one danger zone and one hidden opportunity today. I'll show you both. Stay until the end because I'm giving out the 3 exact entry and exit levels to navigate this structure, and I'm reading your comments live on the channel. Welcome back. This is Alpha Market Meridian. We decode institutional flow so you don't get caught in the noise. Right now, with spot at 4,737, we are sitting at a critical deformation point. Here is your instant market verdict for the next session. The bias is a bullish consolidation threatening a breakout, but it's a fading structure if you chase it here. This is not the spot to be a hero. Write this number down. The invalidation level is 4,677. If we get a daily close below 4677, the entire bullish structure for the week shifts to a range-bound trap and we could see a rapid air pocket down to the 4644 average. That's our floor. Hold that number in your mind. That is the pivot that kills the bulls. Let's dive into the technical deep dive where most traders miss the hidden friction. I want you to visualize the weekly chart. The weekly trend is a beautiful, clean staircase of higher lows, but we are pressing right against a massive structural resistance zone. The zone from 4,759 to 4,808 is the seller's fortress. The 200-week moving average isn't here, but the weekly supply zone is brutal. On the daily chart, we see the same picture. The daily trend is unambiguously bullish. The 20-day moving average is sloping up steeply, acting as dynamic support far below us. But look at the momentum. Here's what the textbook traders aren't seeing yet. On the 4-hour chart, we have price holding above the 20-period moving average, which is great, but the MACD is flagging. Buyers are exhausted. I see a negative divergence forming on the 4-hour time frame. Price is making a slight higher high on the shorter time frames, but the momentum histogram is printing lower highs. This is classic exhaustion before a liquidity grab. The 60-period moving average on the 4-hour chart is sitting right at our key support pivot, that 4677 zone I told you to write down. That's not a coincidence. The algos are programmed to test that level. This is where gold's role as the fear architect kicks in. The structure is nervous, anticipating a catalyst, but not yet breaking down. The daily support is 4677, and the daily resistance is 4759. That is our battlefield. We are in a narrow compression range, and this typically resolves with a spike to grab stop losses on both sides before the true move. Now, let's connect this chart to the fundamental fire and the crosser set narrative that is actually pulling the strings, because gold doesn't move in a vacuum. The top news in the last 24 hours is deeply confusing the algos. The headline read, "Gold up for the week as Trump says Iran ceasefire intact despite Hormuz attacks." This is an absolute gold trader's paradox. A direct supply shock in the Hormuz Strait is wildly inflationary and should send the geopolitical premium through the roof. Yet the statement that the ceasefire holds has muted the panic. It's creating a dislocated premium. Now, we have to cross-check this against our asset web, specifically WTI crude, the geopolitical heartbeat. If oil is not screaming higher through $90, it confirms that the immediate supply fear isn't being priced into physical markets yet. This gives us a clue that gold's pop is pure speculative insurance, not physical panic. But here is the deeper cross-linkage. I'm watching real yields closely. The US dollar index is stable, but the underlying bid for gold tells me the market is betting on a policy mistake by the Federal Reserve. We have inflation sticky enough to maintain a geopolitical floor under gold, but a potential flight to safety bid competing with the dollar. The dollar isn't collapsing yet, so gold is hesitating. Also, keep your eye on the risk asset shadow, Bitcoin, and the S&P 500. If the S&P fails to hold its overnight gains and rolls over heavy, That equity pain will initially cause a margin call drag on gold, a flush lower to that 46.77 level, before the safety bid kicks in and slingshots are higher. That's the narrative web. The 1 to 2 week directional lean is bullish, targeting a sweep of 4800, but only if the Hormuz ceasefire rhetoric fails to calm the shipping lanes. The exact event that invalidates my bullish thesis is a confirmed deal dropping oil prices below $75, which would kill the inflation premium and cause a long liquidation down to 46.44. Here's where money is made. Most people will click away, but this is the execution plan. Keep watching. We have 3 precise strategies to milk this compression. Whether you're a patient sniper or an adrenaline-chasing aggressor, strategy 1 is the sniper, the conservative approach. We wait for the bull trap to flush. The exact trigger condition is a wick down into the 4-hour demand zone, specifically a bid between 4,682 and 4,677. We are not just hitting the bid blindly. We need a confirmation signal, a bullish engulfing candle on the 15-minute timeframe closing back above 46.85. That tells us the liquidity grab is over and the buyers have stepped in. Once that happens, your stop loss goes exactly at 46.43, just below the structural pivot and the daily low zone. The logic is simple. If price falls below 46.44, the consolidation fails. Your first target is a repositioning back to the range high at 47.59, giving you a risk-reward ratio of over 2 to 1. The second target is the breakout play at 4803. What voids this sniper setup? A slow, grinding drift lower into the support zone with no impulsive rejection wick. If it leaks downwards, do not catch the falling knife. Strategy 2 is the active trader, the standard play for those who want to engage with the mean reversion. We are using the 60-minute moving averages as our guide. The entry condition is a pullback to the 60-period moving average on the hourly chart, which is currently dynamic and will sync up with the upward trend line. That entry zone is around 4,705. You wait for a clean hourly doji or a small-bodied rejection candle there. Your stop loss goes 10 pips below the hourly swing low, logically right below the 70-100 round number. Place it at 46.98. Your first target is the day's opening range high at 47.47. Once price hits that first target, immediately move your stop to break even. Your trailing stop rule is simple. Lock in profits using the 20-period moving average on the 15-minute chart. Ride that moving average until the trend breaks and the real fireworks toward 4800 begin. Let's see how aligned we are right now. Type your gold range for tomorrow in the comments. Is it a dead zone sideways, or do we rip through 4800? I'm reading the comments personally and I want to see if the alpha pack is more accurate than the institutional models. Strategy 3 is the aggressor, the high-risk beast for those who love momentum and can handle the heat. This is a counter-trap play. If we break above 47.60 on a 15-minute candle close with a sharp spike in volume, you chase the momentum. The entry is a market buy at 47.62 with a tight stop at 47.45, just below the breakout candle's midpoint. Your first target is a rapid liquidity grab at 47.95. The second target is the psychological barrier of 4808. This is a high-octane strategy. The invalidation is a false breakout where the 15-minute candle closes back below 47.50. If that happens, you're out instantly with a small loss because that is the trap designed to destroy breakout chasers. This is only for those who know how to lose small and manage risk aggressively. Do not widen the stop. This is the risk management pulse. It is non-negotiable. Never risk more than 1 to 2% of your account per trade. No positions held through high-impact surprise. Geopolitical headlines or Fed speakers. Stops are mandatory. No exceptions. A warrior who doesn't respect risk is a pauper in a week. Let's zero in on what matters for the next session. We crushed a lot of data. Burn this into your brain. The most critical level remains 4,677. If we hold above it, the path of least resistance is ultimately higher, targeting the $4,800 breakout. The trap is being set below it. If we lose it, the floor is gone. I'm laser focused on tomorrow. We have the New York session flow and a continued divergence developing in the US dollar index and S&P 500. The risk-reward setups on Bitcoin are even wilder right now. The Bitcoin and S&P 500 divergence video is live, and the correlation fracture is something every gold trader must see because it's pulling liquidity out of gold ETFs. Check the end screen right now. I break down the exact funding rates and a hidden liquidity grab level on BTC that is mirroring this exact gold pattern. Smash the like button if this analysis gave you a map with clear levels instead of vague theories. Subscribe and hit the bell for daily institutional coverage on 8 key assets. We call the moves before they happen. I'll see you in the next one. Go make money. I am Eric from Alpha Market Meridian. Thank you for watching.